Two people, same loan, same interest rate, same day they sign the papers. One of them ends up buried, the other ends up richer than when they started. Same loan, same rate, opposite result. The difference is one number. And by the end of this video, you will know exactly what it is and how to run it on your own situation right now. Because debt is not the problem, using it like you are poor is the problem. The only question that actually matters. Strip away everything you have ever been told about debt, and you are left with one simple mechanism. A loan is renting money. You borrow a sum, you pay a fee for the time you hold it, and you give it back. That fee is the interest rate, that is the rent. So the only question that actually matters when you take on any debt is this. Does the money you borrowed earn more than the rent costs? If the money you borrowed earns 7% and the rent on it is 4%, you kept the difference. 3% on money that was never yours, that gap has a name. It is called the spread, and the spread is the entire game. Here is the one number that ties it all together. Your return on your own money equals the spread times how many dollars you control for every dollar of your own that you put in. The spread is one part, the leverage, how many borrowed dollars you stack on top of yours, is the other. Multiply them and you get the only number that matters, the return on your own cash. A wealthy person does not look at a loan and think, how do I pay this back as fast as possible? They look at it and think, what is the spread and how many dollars can I control with it? Same loan you're looking at, completely different question. Every strategy in this video is that same equation with different numbers plugged in. Some of them you can run today, some of them require a serious pile of assets first. I will be straight with you about which is which as we go. Strategy 1, trade credit, infinite leverage on zero of your own money. This is the oldest trick in the book and one of the most accessible. Here is how it works at scale. You want to sell a product, say, a simple consumer good with steady demand. The obvious approach, spend your own cash to buy inventory, ship it, then sell it. But your capital is locked up in product for months before a dollar comes back. The better approach, you never pay for the inventory up front. Manufacturers, especially overseas suppliers, regularly hand product on terms. Net 30, net 60, net 90. You receive the inventory today and pay for it in 30, 60, or 90 days. The supplier is your bank, the inventory is the loan. Now run the one number on it. You sell the product before the bill is even due. Customer money arrives, you pay the factory, you keep the margin. How much of your own cash was in this deal? 0. You controlled an entire container of inventory with none of your own capital. Which means your leverage is not 5 to 1 or even 10 to 1. It is effectively infinite because you are dividing by 0 of your own dollars. The spread per unit might be modest, but multiplied by infinite leverage, the return on your own cash is mathematically enormous. This is why the ability to sell is one of the most financially powerful skills in existence. The seller never needed money, they needed terms. You can run this today, you do not need an overseas factory. Anyone who has ever collected a customer deposit before starting a job has used trade credit. A supplier who gives you 30 days to pay, a 0% introductory card that floats your inventory costs, a client who pays upfront before you spend a dollar on materials, same mechanism, smaller scale, same math. Strategy 2, real estate, recycling your own capital to 0. This is where most finance channels get the math completely wrong, so let us actually run it. You find a property listed at $500,000. It is in rough shape, which is exactly why it is cheap. You put 20% down, $100,000. You take a mortgage for the remaining $400,000, then you invest $50,000 renovating it. Your own money in the deal, $150,000. $100,000 down plus $50,000 in renovation costs. The property is now desirable. Market value rises to $700,000. You refinance at 80% of the new value. 80% times $700,000 equals $560,000 in new loan. You pay off the original $400,000 mortgage. You pocket the remaining $160,000 in cash. Here is where most channels get it wrong. They say $160,000 minus $50,000 renovation equals $110,000 profit. That is not what happened. The reality is considerably better. You put $150,000 of your own cash in, you just pulled $160,000 back out. You recovered every dollar you invested, plus a little extra, and you still own a $700,000 property with roughly $140,000 in equity that you can now rent out for monthly cash flow. How much of your own cash remains in this deal? Zero. Return on your own money. Mathematically infinite because you divided by nothing. This is the real reason serious real estate investors obsess over this strategy. It is not the profit on the renovation. It is that they recycled their entire down payment and kept the asset. The honest catch, your new loan is $160,000 larger than the original. At today's mortgage rates near 6.5%, that is a meaningfully higher monthly payment. Refinancing also costs 2% to 5% in closing costs. The whole thing only works if the rental income covers the new debt service with money left over. The math is real. Finding the property where the math works, that is the hard part. That is also the part no one sells you a course on. This strategy is reachable, not billionaire territory. People with far less capital than you might assume execute this regularly. Strategy 3: Buy, Borrow, Die. How the wealthy pay almost no income tax. This is the strategy behind every headline about billionaires who pay almost nothing in taxes. It is not a loophole someone snuck into the code. It is 3 ordinary rules stacked on top of each other. Step 1: Buy. You own assets that appreciate over time: stocks, a business, real estate. On paper, your net worth grows substantially, but here is the critical detail: unrealized gains are not taxed. You only owe tax when you sell. So rule 1 is simple: do not sell. Selling triggers the tax bill. Step 2: Borrow. You still need money to live. Instead of selling stock and paying tax, you pledge your portfolio as collateral to a bank or brokerage and borrow against it. This is a real, widely available product called a securities-backed line of credit. Current interest rates on these loans run approximately 5.5% to 6.5%, with the lowest rates available to the largest portfolios. Now run the one number. Your assets are growing at roughly 7% historically. The loan against them costs around 6%. The spread is still positive. You accessed cash, your assets kept compounding, and you never sold a thing, which means you never triggered a capital gains tax event. How much would that tax have been if you had sold? The long-term capital gains rate reaches 23.8%, including the net investment income surtax. Borrowing at 6% to avoid a 23.8% tax bill is not just convenient. It is the entire point. You are renting money at 6% to sidestep a tax of nearly 24%. Step 3: Die. Under current U.S. law, when assets transfer at death, heirs inherit them at what is called a stepped-up cost basis. The gains accumulated over a lifetime, never sold, never taxed, are simply erased. The estate pays off the outstanding loans. The remaining assets transfer to heirs at current market value. The lifetime of untaxed appreciation disappears from the tax calculation entirely. The U.S. Treasury estimates this provision costs approximately $41 billion in uncollected tax annually. And before assuming the estate tax catches this, in 2026, the federal estate tax exemption stands at $15 million per individual, $30 million for a married couple. For the majority of people using this strategy, the final step is clean. Buy, never sell, borrow, live, tax-free, die, the gains vanish. Honest assessment: this one is not available to most people today. You need a substantial portfolio of appreciated assets before any bank writes you that line of credit. But the small-scale version of this exact logic is coming, and it is one you can run right now. Strategy 4: Borrowing against a portfolio, and the dark side of leverage. When you borrow against your investments, the lender does not advance $1 for every dollar you hold. They advance 50% to 95% of your portfolio's value depending on what you own, and they monitor it continuously. Here is the risk. If the market drops and your collateral loses value, the lender can demand you immediately deposit more cash, pledge more assets, or they will liquidate your holdings to cover the loan. This is called a margin call. It is the mechanism that turns leverage from a wealth-building tool into a catastrophic trap. The one number works in both directions. A positive spread multiplied by leverage builds wealth rapidly. A negative spread, borrowed money losing value faster than it costs, multiplied by that same leverage, accelerates losses just as rapidly. There is one form of this worth naming specifically because it is the most dangerous version available to retail investors: short selling. Short selling means borrowing a share of stock, selling it immediately, and hoping the price falls so you can buy it back cheaper and return it. When it works, you profit from a company declining. When it does not work, your losses have no ceiling. If the stock price rises instead of falling, you must still buy it back at whatever it now costs to return the borrowed share. Standard investing, maximum loss is 100% of what you put in. Short selling, maximum loss is unlimited. This is the version of debt that destroys people. Same equation, but the spread can go infinitely negative. Recognizing it and staying away from it is the right call for the vast majority of investors. Strategy 5. The 0% balance transfer, the most accessible arbitrage in personal finance. This is the small-scale mirror of Strategy 1, trade credit, except instead of a supplier lending you inventory, a credit card company is lending you cash at 0% interest. Real balance transfer offers currently provide 0% interest for 18 to 21 months, with some extending to 24 months. There is typically a transfer fee of 3% to 5% upfront. That fee is the entire cost. Run the one number. You are renting a sum of money for approximately 3% to 5% total across nearly 2 years. If what you do with that money earns more than 3% to 5% over that period, a very low bar, you kept the spread. The most straightforward, guaranteed version of this is not some complex financial maneuver. It is moving high-interest debt from a card charging 20% or more onto one charging 0%. The spread there is enormous. You are not trying to earn 3%. You are erasing a 20% plus interest rate and paying 3% to 5% to do it. That is a guaranteed, immediate, risk-free return that almost no investment can reliably match. You can execute this today. Same mechanism the importer used. Same mechanism the borrower against a portfolio used. Borrow cheap, deploy it, keep the difference. The only thing separating the strategies is the scale. Strategy 6. Your credit score, leverage on top of leverage. Look back at the one number. The spread is what the money earns minus what the money costs. Most people focus entirely on the earning side, how to find better investments, higher returns, more opportunity. Wealthy people obsess over the cost side because every point you reduce what money costs goes directly into the spread. And the cost of money is something most people can control more than they realize. The national average credit score is currently 715. The difference between a fair score and an excellent one translates to several percentage points across every loan you will ever take: mortgages, car loans, business lines of credit, personal loans. Those percentage points compound into tens or hundreds of thousands of dollars over a lifetime. On a $400,000 mortgage held for 30 years, the difference between a 680 score and a 760 score can easily represent $50,000 to $80,000 in total interest paid. That is money that either goes to the bank or stays in your pocket, determined entirely by a number you can actively manage. Wealthy people do not have access to some exclusive private bank. They have access to cheaper money because they made themselves cheap to lend to. And unlike picking the right investment or finding the right property, improving your credit score is almost entirely within your control. This is where everyone reading this can start moving the one number today. How to run the one number on your own life right now. Start with the cost side. It is the fastest win and costs you nothing. Pull your credit score this week. Find out what your money actually costs today. Every point you raise, it lowers the rent on every dollar you will ever borrow. Pure upside with no downside. Then look at the highest leverage accessible move. If you are carrying a balance at a high interest rate right now, you are on the wrong side of the one number. You are paying 20% plus to borrow money and the spread is deeply negative. Flip it. Move that balance to a 0% offer. Pay 3% to 5% in transfer fees instead of 20% plus per year in interest. You just converted a negative spread into a positive one. That is not theory. It is something you could execute before this week is over. And the trade credit principle applies to anyone who sells anything. Collect a deposit before buying materials. Use the 30 days a supplier gives you before you have to pay. Get paid before you spend. Every time you do, your own cash in the deal decreases and the one number improves because you are dividing by less and less of your own money. The real takeaway. Here is the entire video in one line. Debt is rented money. The only question that ever mattered is whether what you do with it earns more than the rent. Get that inequality on the right side and debt stops being something that owns you. It becomes something you own. The strategies in this video span every scale from a balance transfer card to a billionaire's securities-backed line of credit. The math underneath all of them is identical. The one number is the same. The spread multiplied by the leverage equals your return on your own capital. People who build wealth with debt are not smarter, they are not luckier, they just know which direction to point the equation and they run it on purpose. Now you know how to run it too.